Ladies and gentlemen, good day and welcome to Gravita India Limited Q4 FY24 earnings conference call hosted by Antique Stock Broking. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing the star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Manish Mahawar from Antique Stock Broking. Thank you and over to you, sir.
Thank you, Steve. On behalf of Antique Stock Broking, I would like to welcome all the participants on the Q4 FY24 earnings call of Gravita India. From the management, we have Mr. Yogesh Malhotra, Full-time Director and CEO, Mr. Vijay Parikh, Executive Director, Mr. Naveen Prakash Sharma, Executive Director, and Mr. Sunil Kansal, CFO on the call. Without further ado, I would like to hand over the call to Mr. Malhotra for opening remarks, post which we will open the floor for Q&A. Thank you and over to Mr. Malhotra.
Thank you, Mr. Manish. Good afternoon, ladies and gentlemen, and welcome to our Q4 and financial year 24 earnings call. I trust you have had the chance to go through the earnings presentation and financial results that were uploaded on the stock exchanges. I am delighted to announce that Gravita has delivered outstanding performance for the quarter and the financial year 2024. We have achieved record high revenue, EBITDA and PAT for the quarter as well as for financial year 24, despite some logistics disruptions. Before we delve into the results, I would like to share some strategic highlights and project updates. I am pleased to announce that Pure Lead produced at Gravita's Mundra, Gujarat has been impaneled as an approved lead brand deliverable against MCX lead futures contract. The Pure Lead manufactured by Chittoor and Phagi plants of the company are already MCX panel products. The MCX empanelment will provide us with an additional platform for hedging better inventory management and price transparency in the domestic market. Gravita's step-down wholly owned subsidiary situated in Tanzania, Gravita Tanzania Limited, has increased the battery recycling capacity by 5,000 metric ton per annum, bringing the total capacity of battery recycling of this unit to 12,000 metric ton per annum. Capex of rupees approximately 3.5 crore has been done for this capacity expansion, and the same has been facilitated through internal accruals. The Board of Directors have approved an interim dividend of rupees 5.2 per equity share, making Gravita a consistent dividend payer with a 13-year long track record of sustainable dividend payouts. Our conviction lies in the interdependence of our success with the well-being of our employees, the environment, and the communities that we engage with. We have created a clear ESG roadmap through which we affirm our dedication to sustainable growth and making a positive difference. In our ESG roadmap, we have clearly outlined our short-term, medium-term and long-term targets that are expected to be met by financial year 27, financial year 34 and financial year 50 respectively. You can find the detailed ESG roadmap on our website. Coming to the operational performance, on the capacity expansion front, Gravita has expanded its total capacity to 3 lakh plus metric ton per annum in financial year 24 compared to 2.34 lakh metric ton per annum in financial year 23, which shows an increase of 29%. We aim to increase our capacity to 5 lakh plus metric ton per annum by financial year 27. Discussing about the volumes, sales volume saw a sequential increase of 9% in financial year 24 and 14% in Q4 financial year 24. Lead and plastic volume increased by 25% and 8% to 40,634 tons and 3,540 tons on a year-on-year basis, whereas aluminium volume dropped to approximately 3,200 tons. The reason for drop in aluminium volume is to avoid high risk of metal price fluctuation during transit period for imports in India. As you are aware that we are in process of finding solution for hedging of aluminium, we are pleased to inform you that aluminium alloy has been notified under Securities Contract Regulation Act 1956 by Ministry of Finance, and we are expecting launch of this aluminium alloy commodity derivative on MCX by next quarter. This will help us in managing the risk of price volatility and in turn help us in scaling our aluminium business. Coming to quarterly EBITDA per ton performance, EBITDA per ton for plastic is rupees 11,176 per ton, lead is 19,252 per metric ton and aluminium is 15,308 per metric ton in Q4 financial year 24. This is in line with the company's target. Moving to financial results, I am delighted to share that we have achieved record high financial performance quarterly as well as annually. Gravita has achieved an outstanding 5-year revenue CAGR and PAT CAGR of 21% and 74% respectively. Revenue for financial year 24 increased by 13% to rupees 3,161 crores. 45% of revenue in financial year 24 came from value-added products, which is in line with our vision of achieving 50% revenues from this category. India contributed 62% and the balance contribution of 38% is from overseas business. Adjusted EBITDA for financial year 24 increased to rupees 331 crore, up 16%. PAT showed significant increase of 19% to rupees 239 crores in financial year 24. PAT margin increased to 7.6%. ROC for financial year is standing strong at 25%, which is in line with our vision 2028. Coming to Q4 financial year 24, revenue for the quarter increased by 15% to rupees 863 crores on year-on-year basis. 44% of revenue in Q4 FY24 came from value-added products, in line with our target to reach 50% of overall revenue from value-added products. On a year-on-year and a quarter-on-quarter basis, adjusted EBITDA increased by 9% and 4% respectively to rupees 93 crores. EBITDA margin stood strong at 11%. Gravita reported a PAT of rupees 69 crores with 8% and 14% growth on year-on-year and quarter-on-quarter basis respectively. PAT margin remained steady at 8%. Further, we would like to also clarify on the qualification of recent financial statements with respect to accounting treatment of sale of shares held by trust for benefit of employees of Gravita. The qualification is just difference of interpretation of accounting standards which needs to be understood. Gravita Employee Welfare Trust acquired certain shares of the company in the last few years with an objective to utilize the gains of the fund for benefits of employees of Gravita. During the year, 380,500 equity shares held by the Gravita Employee Welfare Trust have been sold and the capital gain or surplus from the said sale will be utilized for the welfare of the employees of Gravita as per the requirement of the trust deed. The trust, being an independent entity, has sole responsibility and obligation to utilize the fund for the welfare of the employees of Gravita as per the terms of the trust deed. Based on the independent legal opinion from reputed law firms, management of the company is of the view that the distribution of the utilization of gains arising on sale of such shares is not an expense. The surplus or gain is considered as other liability in the balance sheet of the trust and the consolidated financial statements. Further, it is to be noted that it is just an issue of interpretation and has no impact on the net worth of the company, and the accounting treatment has been done appropriately in the financial statements. In conclusion, I wish to highlight that Gravita is making significant strides towards realizing its ambitious Clear Vision 2028. Our focus on diversifying into new business verticals like lithium-ion, steel and paper, aiming for revenue CAGR exceeding 25%, profitability growth surpassing 35%, maintaining an ROC of 25% plus, elevating non-lead business to over 30%, using 30% plus renewable power and reducing energy consumption by 10% underscores our commitment to sustainable development, increasing the proportion of value-added products to 50% and proactive risk management through back-to-back hedging will contribute to resilient and sustainable margins. With our DNA of 31 plus years and 12 eco-conscious state-of-art manufacturing facilities across the globe, global footprints in 70 plus countries, integrated supply chain, and which is backed by strict government norms of BWMR and EPR, and robust stakeholder support, we are confident in achieving our Vision 2028. That's all from my end. I would now request to open the floor for questions and answers. Thank you, and over to you, Mr. Manish.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mr. Amit Dixit from ICICI Securities. Please go ahead.
Yeah, hi. Good afternoon, everyone, and thanks for taking my question. I have a couple of questions. The first one is on the vision. So earlier it was the vision to 2027, but now in this presentation we see vision to 2028. So just wanted to understand exactly what has changed in the vision, whether we are thinking of delaying certain capex elements or whether the capex is expected to go up further, or there are some risks or challenges that we see that has resulted in this delay of 1 year.
Actually what we are doing is we are doing a rolling 4-year vision. Last year it was 27, so going forward it is vision 2028. We have incorporated some additional landmarks in this vision, especially on ESG front, as I mentioned. And also we have increased certain other landmarks also. For example, in Vision 2027, we are mentioning that the non-lead business would be 25%, but in Vision 2028, the non-lead business, we have increased the percentage to around 30% plus. So it's in line with the Vision 2027, but we are giving visibility for 1 year further.
Okay, wonderful. Got it, actually. So that will be like next year it will be Vision 2029 then with some possibly more things added. Okay, understood. The second question is that since we are working with MCX and there has been some kind of, circular also being floated on inclusion of ABC 12 perhaps for the, so that would facilitate hedging. And does this also mean that our aluminium capacity, particularly to India operations, now since we have got a good hedging thing, so that capacity utilization would also improve? If so, possible to share some numbers where we can, what we can see once the hedging is active actually on MCX.
Yes, correct. Last year we had only capacity utilization of 11% in case of ADC 12. So this year we plan to increase it once these get implemented, and we expect that it should be, the derivative should list somewhere in next quarter, and then brand empanelment will start. So maybe in Q4 we have certainly growing volume, and next year further we'll foresee the volume growth and capacity utilization to higher levels.
So this is basically the capacity utilization of Indian plants.
But yeah, overall it was around 37% for the group as including the overseas business.
Yes, sir. Possible to give us an idea what could be the exit rate of capacity utilization in FY25, the exit rate of your aluminium India operations?
Aluminium India operations should touch around 65 to 70%.
Okay, that should be the exit rate, and then that would be the broad base, going forward.
Yes. And there will be further capacity addition also we are planning, especially for our country in Ghana.
Okay. Great. Okay, sir. Thank you so much and all the best.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Thank you. The next question is from the line of Shubmangal Nevatia from Kotak Securities. Please go ahead.
Good afternoon, sir, and thank you for this opportunity. And also thanks for clarifying the accounting treatment, which was kind of highlighted in the notes. So my first question is on the ongoing Red Sea issue. It was good to see some growth despite the logistic issues which are continuing. Is it possible to share what sort of alternate arrangements we are doing, and do we return back to our normal growth of around 20% plus from FY25 onwards?
Yeah, this is Vijay Parik, and I look after the international as well as domestic marketing. So whatever logistic issues was there with respect to this Suez Canal issue, we addressed that particular issue while diverting the volumes to other geographies. Although we are having the customer base around the globe, so wherever we were encountering the problem, we diverted the volumes to other geographies without affecting the volume growth.
So there was some impact on the volumes in the quarter three, but now we have already started shifting the volumes from quarter three onwards. So now we think the volume level from the base for the quarter four is the base for the growth of another 25% in the next year.
Okay, and what are we compromising or sacrificing when we are diverting? Is it some at the expense of slightly lower margins?
Yes.
Or
so the margins would be affected, but not that much, because we also use some arbitrage opportunities. Some of this is getting diverted into India, where the realization is a little better. But of course, the working capital cycle takes a hit whenever you do some diversification. So it's more towards increase in working capital cycle and less on EBITDA per ton margins.
Understood. And I mean, was it completely resolved in fourth quarter, or it was more of a gradual thing and 1Q should see further improvement?
No, in times to come, once the situation gets normalized, then we will be again using the similar customers. But yes, we have the flexibility also with the customers for diverging the volumes. So till now, effect is there, although some part of the impact has been nullified, but yes, the issue is going on.
So again, working capital part, which we are lacking at this moment, that will be improved further after this situation is further resolved.
Okay. Yeah, I mean, that was actually the second question. The working capital has increased, whereas our guidance has been we should gradually move towards 60-65 days. So is it possible to share some more details? Why was this increase, and do we see it normalizing in 1Q or in FY25 overall?
Yeah. So if you see that, I mean, part of the sales that was to happen in Q3 happened in Q4. So you would see a lot of, receivables that has gone up. But as we sit right now, there has been a reduction in receivables by around 125 crores. So it's only a temporary thing. I mean, so the overall inventory levels are in line, although they are a little, not exactly as per the targets that we have envisaged, but once these things normalize, I think we will be back to the same issue. I mean, we will be back to the same target of reducing the inventory levels. Also, there is another thing that has happened is that this year we have not taken as much domestic scrap simply because the overseas scrap was much cheaper compared to the domestic scrap, as there was some arbitrage opportunities. Overseas market was lower compared to Indian markets. So we bought more international scrap as compared to domestic scrap. So that has also contributed to increased working capital cycle. Although it's a more profitable business, so we have gone and taken more international scrap. So once this arbitrage opportunities, which in this quarter has almost normalizes, then again the domestic scrap will increase and the overall inventory cycle would reduce.
I hope we have answered your query, Sumangal.
Thank you. The next question is from the line of Yash from Stallion. Please go ahead.
Order book equal to next quarter revenue. Prediction
Can't hear you properly, sir.
260.
Excuse me.
हाँ, तो तेरा सितंबर का यहाँ पे आया ना, सितंबर का जो ऑर्डर बुक था वो अभी
Hello.
में था। तो समझा मेरी बात?
So we can't hear you properly.
The current participant line has been disconnected. The next question is from the line of Hemant from Self, from an individual investor. Please go ahead.
So thank you for providing me the opportunity. So this, I have only one question. We have provided revenue growth somewhere in 25% and PAT growth of 35%, right? Earlier in our Vision 2027 program, now in Vision 2028 program.
Sir, your voice is not proper. If you can slightly speak louder.
Yeah, sure. So we have provided the revenue number as well as the PAT number. It was under the Vision 2027 program and now under 2028 program. So it was 25% revenue growth and 35% PAT growth. But if I take a look at the FY24 numbers, I don't think that the revenue numbers have grown by 25% and the PAT numbers have grown by 35%. Is there any specific reason for that?
Yes, sir. So, actually, when there are 2-3 reasons. First of all, when we mention this 25% CAGR, it's a long-term guidance, and it's not a short-term guidance. So there would be years when we would grow faster than 25%, and then there would be years when the growth would not be in line with 25%. So if you look at the past 5 years, the revenue growth is 21%, and the PAT growth is 74% CAGR level. This year was also affected by some logistic issues in quarter 3, which has impacted the growth rate to some extent. And we are very confident that going forward, our vision of 2028 of long-term CAGR growth of 25% and PAT growth of 35% is achievable.
So, sir, can we expect that the growth numbers in terms of percentage, FY25 over FY24, FY25 over FY24, should be higher than the growth in terms of percentage in FY24 compared to FY23?
Yes, we are optimistic of achieving higher growth, but we would stick to the 25% CAGR growth for the next 4 years. So that is the bottom line. So maybe this year probably would grow maybe 30% also. It can grow at 25% also. But definitely 25% is the minimum growth rate that we can expect in the next year. It would be probably above 25%, but that is the bottom line.
Okay, sir. Okay, thanks a lot.
Thank you. The next question is from the line of Rahul Bangadia from Lucky Investment Management. Please go ahead.
Thank you for taking my question, sir, and congratulations on a good set of numbers in somewhat difficult circumstances. 2 questions on the P&L. One is, if you could just give us a sense of the drop in the employee cost that we have seen on a quarter-on-quarter or even a year-on-year basis.
Yeah. So, basically, the employee cost includes some part of incentives also. So, and the incentive, if we have already... So we make provisions for incentives on a YTD basis. So, whatever targets we have achieved, that has been already provisioned for in Q3. So there was higher number for Q3 because we have provisions slightly higher, expecting some better numbers in Q4. But because we could not achieve, the growth could not achieve, so then the incentive part is reduced. So accordingly, so this incentive is a variable factor which keeps on changing every quarter or every. So that is the reason, only reason where employee cost is lower in quarter 4 as compared to quarter 3, because the provision for incentive are higher in quarter 3.
Okay. And sir, the second question was on the tax rate. From what we can see in the presentation, the contribution of the Indian operations to the overall PAT is now much higher. In fact, it is almost 3x of what it used to be in 2 years back. FY22, Indian operations were 25% of PAT. Now this year it is selling almost 75% of PAT. But our tax rate seems to be low. To my limited understanding, the tax rates were low because of the contribution of the African operations to the PAT. So some sense there, please.
So actually, if you look at the total numbers, because there were some arbitrage opportunities in India, because of which we have diverted some of the materials from the African operations into India, and also because of this Red Sea situation, also some of the material from the East African operations was diverted into India. And so the overall increase in EBITDA margins in that, if you see that as against rupees per ton, we have increased EBITDA numbers, and that has contributed to the increase in the overall profitability from India.
No, so my question was more related to the tax rate. I mean, assuming India works at a nominal tax rate and Africa works at a much more subsidized or probably very, very low tax rate. If the profit contribution from India is this high, I would have assumed that the tax rate should have been higher. So, but the tax rates have not gone higher. They remain in that 10-12% range. So that's why I'm asking.
Yeah. So basically, in India also we have tax advantage in Chittoor, where we are enjoying 100% tax exemption. So whatever profit contribution is from Chittoor, that is 100% tax free. So because whenever we are importing certain goods from Africa to India, that is majorly processed in Chittoor itself. So that's the reason we have the higher margins in Chittoor, and which is tax free entity. So tax percentage has not gone up because of this issue.
But Chittoor has some special, tax exemption under some government.
Yeah, 80IA exemption for Chittoor.
Okay. Okay, sir. Thank you. Thank you very much. Thank you.
Thank you. The next question is from the line of Sabri from MK Global. Please go ahead.
Yeah, good afternoon, sir. So, I have two questions. Firstly, regarding this BWMR regulation, so it's been like 1 year now. So how has been the experience? Have we seen share of organized volumes in the industry going up? And what is the expectation for the next 1 year in terms of implementation of this?
Yes. So after implementation of this, the next stage was EPR was the additional thing which was created under this regulation. So now the central portal has started working. The producers has been registered, and recycler also getting registered, and the EPR certificate for the financial year 22-23 are also in the process of generation by various recyclers. The next stage is the EPR penalty. So for non-compliances, those numbers are yet to be released. So there are meetings going between the producers and recyclers. So we hope by next quarters, the EPR penalties will come. So that will create a financial model. So that will be the second stage. So certainly the numbers are growing. The producers are getting them registered, and they will be diverting more material to formal sector.
So some of the manufacturers or the brand owners are basically waiting and watching. But once these penalties are decided, so then probably those who are watching also will start implementing this waste management. So overall, we believe that after this first quarter, when the penalties are decided, there will be even further increase from the current levels also.
Right now, it's at 35%, or is it like higher or lower?
So it would be, say, I mean, there is definitely some increase, so it would be around 40% currently the organized sector would have increased.
40% versus, say, 35% couple of years back, right?
Yeah, but you must understand that overall, in the first year, the requirement is also only 30%. So it will only gain traction once the 50% or 70% and then 90% of the total volumes that has to be recycled would come into play. So getting up to 30% is not that difficult. But now from 30 to 50%, if they want to do it in the second year, then people will start going for more from the retail.
Right, sir. Got it. And second question is on this depreciation. So it has increased. So which are the plants or capex which has been expensed this quarter?
Yeah, basically major expansion we did it in Mundra, so which has started Mundra and Togo. Togo was a new facility. So these are the two new plants. Also, we have shifted the new facility in Senegal. So that's also, although the capacity is not changed significantly, but yes, the plant was totally new. So that is the reason there is a higher depreciation in this year.
Was there any working capital impact from this also?
Not that much. Actually, CapEx is only a small part. Most of the working capital